CNBC TV18 eBix Cash Studio.
Hello and welcome to the CNBC TV18 eBix Cash Studio. I'm Sumaira Abidi and you're watching MF Corner. Today we're talking about foreign-focused funds and what to do with them. Mohit, CEO and co-founder at Moneyfront, and Prableen Bajpai, founder of FinFix Research, join in. But first, let me just explain the story so far. So on the 30th of January, the Association of Mutual Funds of India sent out an advisory to all asset management companies to stop fresh purchases of stocks overseas because the industry-wide limit of $7 billion had been hit. Now, what does this mean? That all mutual funds combined could invest up to $7 billion in buying foreign stocks for their schemes. And the various funds now had reached this cap collectively. So to continue to keep buying, they have now petitioned the Reserve Bank to increase this limit upwards. But we're still waiting for any announcement on that front. In the meantime, nearly 50 schemes across 14 AMCs which had foreign mandates have stopped taking in fresh money. In fact, 2 have even stopped existing SIPs. So let's understand the fate of these schemes and their investors. And with us, we have Mohit and Prableen Bajpai. So thank you very much to both of you for joining in. So let me begin first with, to just talk about how does this really work, right? Mohit, how does the Reserve Bank decide what the limit should be? And therefore, how soon do you think we can hear about this revision?
Okay. Hi, Sumaira. Good afternoon. Always a pleasure to be on your show. So I think India has never been a fully convertible currency on the capital account, right? It was only after the Tarapur committee set out some limits and gave its recommendations that India became a partially convertible country when it comes to capital account. Technically, so what it means effectively is that Indian currency is not transferable, or you can't move Indian currency outside. Neither can foreign investors come and exit at their will. And neither can, nor can Indian investors go out and invest into capital assets, which means invest into stock markets, fixed asset, real estate, and everything. It is controlled and governed by RBI. So even at an individual level, there is an LRS limit of 250,000 every financial year, which RBI keeps revising from time and again. And for mutual fund industry, in 2008, they set a limit of $7 billion. At that point in time, it was a big limit, almost like in today's terms, almost 52,000 odd crore kind of a limit. But last 2 years itself, the AUM in overseas investments have actually grown 10 times, and the number of schemes have doubled or more than doubled just in last 2 years. And now we are here where we are, where we've reached that $7 billion kind of a cumulative limit. But it's not an easy call by RBI, Sumaira. To be very honest, everyone thinks it can be done in a quick jiffy, but it's not, because there are many variables to it. US yields have been going up. There is any which ways Indian currency is under a lot of pressure because the yields have been going up, and foreign investors will pull out money from the markets if the US yields continue to increase, which is a very likely scenario, given that they have indicated 3 rate hikes this year, right? So it's a very tricky rope walk for the RBI. I'm sure the limits will be revised pretty soon, but it won't be coming without any conditions or without any binding clauses. My sense is it will be a calculated move by the RBI.
Okay. Prableen, is there a fear that this limit may not be increased, or that this limit may not be increased soon enough? And realistically speaking, how much should be the limit currently?
Hi, Sumaira. I partially agree with what Mohit has said, that this may take time and there may be reservations. But if we are a developing country and if we need to, progress further, I think these sort of restrictions would only hamper the progress of the industry and as an economy on the whole. If I like to draw a parallel to, let's say, how LRS has worked in the past, I think, because that can give us a background of how probably limits can work here. LRS, which is, for an individual level, if you want to send your kids abroad, so you, of course, have to transfer money, or if you want to invest directly in stocks outside, you need to travel or for vacation purposes. So this was introduced in 2004, and the limit at that time was only 25,000 per individual USD. And then eventually in December of 2006, it was increased to 50. So it was doubled. By May of 2007, again, it doubled and it became 1 lakh US dollars per individual. And by the end of that year, 2007 September, it was again doubled to about 2 lakh per person USD. And Sumaira, interestingly, in August of 2013, August 2013 was a year which was tricky economy-wise, and globally there were issues on the financial front. RBI had actually reduced this limit back to $75,000 per individual. And gradually it was again revised in 2014 and 15, and it now stands at 2,50,000 USD per individual. So what I feel here that RBI would, so there's always a scope for them to, let's say, lay restrictions or to go back to the limit that they set. Now the 7 billion that was set up in 2008, I think it was really progressive from that time period. But if we see today, I think RBI should and will eventually increase it. I don't see much reservations there, because if we see the US, globally the trend, US funds themselves are investing in India, and the AUM of those funds, and I'm only talking about the ETFs, is about 8 billion US dollars. And the corpus that they have in Chinese, ETFs and direct stocks through ETFs is about 30 billion. So I feel that this would be revised, and given the trend how the industry has moved, when this was set at 8 billion, Sumaira, interestingly, there are only 8 schemes which are 14 years old, and the AUM was barely 29. Is now at 29 million for those 8 schemes. So it was definitely less than half at that time.
Yeah, and there's no doubt that, as of current standing is grossly inadequate. Mohit, you spoke earlier that, if a limit is increased, there might be some conditions that go with it. I mean, can you explain what that might be? Also, what is a realistic limit for today? And, someone I was speaking with earlier suggested that maybe the limit should be dynamically linked to the growth of assets in these funds. I mean, is that a plausible solution? And, what could be the possible solutions here?
Yeah, look, so honestly, I think the limit when it was set was a point of time limit, which was you can't breach this quota of 7 billion, and 1 billion was set up for ETFs. And within that, there are sub limits. So which is you have a $600 million limit per fund house, and within the ETF also you have a sub limit, right? So RBI has done that, but I think what you're suggesting makes immense amount of sense to make it a dynamic limit or make it a financial year kind of a limit, which is linked to some underlying parameter. Now that parameter could be the overall as an overall percentage of the mutual fund AUM. Right. So if you have a 35 lakh thousand crore industry or 37 lakh thousand crore industry, this could be the percentage which could be held in international or overseas stocks and so on and so forth, basically. And I also believe that this time it won't be like a simple straightforward revision of the limits. It will come with in a more dynamic fashion. Ideally it should, because after a long while this will get tackled, and perhaps RBI is also taking time because they might just want to set up a dynamic formula to keep revising this from time to time.
Prableen, would an annual review work?
Annual might be too soon, I feel, Sumaira. But yes, I think a review has to be there. So maybe once in every 2 years it can be done. I think that would definitely make sense, because I think at this stage, at this point in time, RBI can increase, or whatever they decide, they can increase it, and then they can probably ask for a yearly recommendation, let's say from SEBI and AMFI, and then probably work on it. So they may not revise it, but they can definitely have a recommendation, I think, coming in from SEBI and AMFI, who would be tracking these numbers much more closely. Okay. But yes, as we move forward, I think a revision of the limits would be required. And even now, when, per fund house it's at 1 billion, and we have almost 40 plus fund houses. So even if they want to use their own limit, basically we are only catering to that 7 billion for 7 fund houses. So definitely a review of this is required,
All right. So far we have discussed the bigger picture about, what is the limit, why is it there, how can it be increased, how soon. Up next, we'll talk about, what an investor should do. There are many investors. I mean, this is a category which has been growing, in popularity. So what should those investors do? Should you hold off your SIPs, till the time that the limit is increased? What is the solution for investors? Mohit and Prableen will talk about that when we return. Stay tuned. Hi, welcome back. We're talking about what investors should do with their foreign-focused funds. With us, we have Mohit, CEO and co-founder at Moneyfront, and Prableen Bajpai, founder of FinFix Research. So, Prableen, we have spoken about, the bigger picture. But the one thing that everybody wants to know now is what should existing investors do? Because, pretty much every scheme has stopped fresh inflows, but few have even stopped existing SIPs and STPs. Is that a trend that could catch on, that even existing SIPs and STPs may be stopped by AMCs? And in any case, what should investors do in the interim?
Sumaira, if we are looking at the overall AUM only in the international funds, be it FOFs or active funds as the underlying funds, whatever format we have, the overall AUM works out to be approximately 45,760 crores as on the latest data that I saw. And if we are converting this, so obviously this is a plus 6 billion. Plus, we also have so many schemes which have partial mandate to invest outside. So, of course, we are on the verge of reaching the limit of 7 billion. So even the AMCs which are currently allowing inflows would at some point, if the limit is not increased, will have to probably put further restrictions that they don't take SIPs. Having said that, there are a couple of schemes which are open, and investors, existing investors, firstly for them, I think there's no need to panic. Whatever money has been invested continues to remain invested. And if they wish, they can withdraw that money and do a SWP. Redemptions are open. Obviously, their investment should keep going. And if their limit is not increased, then there will be a review which will be required in their own strategies. But I think at least 2 to 3 weeks must be given before a decision is taken. And for couple of schemes, investors who are looking to still invest outside, there are a couple of schemes which are still open, Sumaira, because the underlying assets there are the overseas ETFs. For example, Kotak, ABSL, Nasdaq funds. The underlying ETFs are overseas ETFs, so those are open. The DSP Global Innovation NFO is open. But of course, all these will be subject to limitations going forward, any inflows that we are taking. So I think the only way out here is to have an extension of the current capping that we have. And if that is not done, then I think majority of the investors would eventually move towards directly investing outside, wherein they would be using their LRS limits to invest. And one more point, Sumaira, I want to add here, that unlike, when we're sending our kids abroad under LRS or any other remittance outside, that doesn't come back. But when we are investing outside the country, today, yes, there is an exchange rate and, the conversion into USD will take place. But this is the kind of money which would also come back into the country. So, we would also see that these limits go up and down, and this is not a permanent outgo from the country.
I understood, yeah. Mohit, how long before investors' patience starts running thin, and do you expect that existing SIPs, STPs how long? Is it like 1 month, 2 months before AMCs will have to stop even the existing SIPs, STPs? How long and painful can this wait be?
So, look, Sumaira, from what I understand, typically AMCs who are collecting funds and continuing the SIP and STP mechanism, what they are primarily going to do is they're going to park it in debt or park it into cash or TREPs, basically, because they can't any which ways invest overseas. So they won't be buying or purchasing any more fresh equity which is held outside of India, right? So investors who are investing will have to be cognizant of the fact that their existing portfolios continue, their existing holdings which they are having, the underlying stocks which they hold by virtue of having those schemes will continue, and those allocations will continue to work for them. But the fresh monies which they are putting in might perhaps not work for them in the same fashion as it was doing before. Having said which, I think I agree with Prableen out there that we need to wait for a month. If RBI revises the limit within this month, then I think well and good, we are back on track. But if not, then it can take any longer. And then it's anyone's guess what would be the clauses and when would RBI actually come out and revise. And then I think perhaps it will be a time for investors to kind of at least stop their existing SIPs, because if the money is not going for actual purpose, then there's no point investing into existing SIPs. And also, few schemes which are ETF oriented, which continue to take investments, I think those are open and investors can consider that for their fresh international allocations.
But Mohit, this interim won't impact the performance in these schemes?
It should ideally, yes, because if you hold more and more in cash, I think that impacts the performance somewhere, because finally the mandate is to hold in overseas equities and you're not fulfilling that mandate, right? So definitely it will impact. 1 month, I think, is a good enough time period for every investors to wait and watch and see what RBI kind of does out here. Otherwise, I think stopping fresh SIPs should be a good call and continuing with your existing investments, which you should, because that's part of your international allocation. I'm sure everyone has done that by virtue of their overall financial plan and risk profile and everything. So that should not be tampered with. But putting fresh funds, you will have to reconsider if nothing happens on the revision of limits.
All right, Prableen, Mohit, thank you very much for explaining this topic to us and also for advising investors. So for now, anybody who has money being invested in foreign-focused funds needn't, be alarmed. There's no cause for that yet. The petition is with the Reserve Bank, and pretty much everybody I speak to says that the limits will be increased. The only question remains to what extent and when. Well, for that, we have nothing else we can do except wait and watch. Thanks very much for watching. Do stay tuned in. The team of Closing Bell joins you next.